Hello, Vermonters, for another installment of The Bloated Dome, as we look at this tick belly that has been just sucking the blood as it gorges itself out of our taxes and our rights. I have an article coming out about the pensions. I actually have two articles coming out, and I'll discuss them in due course here. In the first one, I want to talk about the underlying deficit in the pension, just how big it is and why it's so big. And then in the next episode, as we discuss and connect the dots on our pensions and why they're in such serious trouble for everyone, I would like to discuss about how this has been politicized and how it is political. And it is a political fix, I suppose, to the extent that we need to be bipartisan in finding solutions. The state of Vermont did a task force on the pensions. They have a January 5th, 2022, I beg your pardon, January 10th, 2022, Pension Benefits Design and Funding Task Force report. And in it, they found that the pensions have grown so grotesquely out of size, and this is my interpretation, that we're going to have to really restructure them even more than Act 114 did, especially since what's happened since this report. This report is dated January 10th. And on January 5th, the United States stock market, the Dow Jones in particular, hit a peak. I think the S&P was in a comparable area. So in order to justify new funding for these funds, which it's great that the legislature is doing that, but as I'll show you, it's not enough. They said this in the task force. They said, across all funds, the fiscal year 2022 pension expenditure is now larger than total appropriations for entire categories of state government functions. For a sense of scale, the $316.2 million of combined VSERS and VSTRS contributions is more than state government spends on labor, debt service, commerce, and community development, and higher education combined. Employer pension costs, therefore, are expected to grow faster than the state... hang on, I went too far there. Faster than the state revenues available to pay them when assuming all actuarial assumptions will be consistently met moving forward. That's at pages 23 and 25. But meanwhile, there have been these chronic shortfalls in these pensions, so it's in a bad way for a number of reasons. And what happened was, in the 07-08 economic collapse, Vermont was heavily invested in those equities in the market, and our pensions took a real hit. They were already underfunded significantly at that time. The pensions then pulled their money out of the market and missed a lot of the rebound, and they performed very anemically. They didn't perform well. They have a lot of high fees. They don't have a lot of high returns. And in the last year or so, they've done very well. But the pensions had assumed a return of 8.25% on invested assets over 20 or 25 years as a reason to calculate how much should be paid in. And that was an unrealistic return. And this task force said, well, after 07-08, we reduced it down to 7%. So now all the assets and the $6.2 billion deficit that this task force report states is our deficiency at this time, this would be of June 30th of 2020, is built on the assumption that assets will earn 7% a year forever, basically. And so the problem with this, we can see right now in what happened right around since this has been passed. The legislature put $75 million each into the two big state funds, and then proposes to put $15 million a year starting in 2023 or 24, I believe 2024, the statute, Act 114. And then that's supposed to bring it back into balance. But between January 5th and January 30th, the stock market dropped by 16.7%. And so as I go through some numbers in the article, I basically take what the balance is, because I don't know what the current balance is, and I don't think that's readily available at the Treasurer's office. But I took this report, and I took documents that I could get from the Treasurer's office, and I used the balance of assets in the pension fund at the end of June 2020, and I then increased that by the amount the stock market rose over that time period to January 5th, multiplied by 71%, which is the allocation that the fund states it wants allocated to equities, and that would be therefore stocks on the market. So this excludes bonds or other things that may have gone up or down. But what this shows is that this pension fund could very well probably lost somewhere in the neighborhood of, let's see, about $673 million is what it lost in about a month, possibly. Now, it would be great to know from the Treasurer's office what it actually lost, but the market dropped 16.7%. It actually dropped more than that, a total of 21.7%, but then it rebounded. So this is as of just this weekend, and of course, I'm using some fictitious numbers. But the real purpose of this is the analysis of how warped the accounting has been for this. So if the state just lost $673 million in investments because it was highly invested again in a stock market that tanked, losing a lot of its gains over the last year or two because it had made a lot of gains. But that money was invested and presumed to be earning 7% for the next umpteen years. And if we put $30 million a year into this fund, it would take 22 years now to recoup the $670 million dollars that we just lost, roughly. I've got the numbers here. But again, these are just demonstrative of what happens when you start making these projections using unrealistic predictions. Because we just lost probably 15 or so percent in just a few weeks. And you've predicted that we're going to earn 7% on all investments for the next 20 some years, which if we were to calculate that $673 million at that 7%, that means there's an unfunded relative liability of $2.982 million, or I beg your pardon, $2.982 billion. When you lose $700 million in principal that you've projected to earn 7% for 30 years, you need a lot to replace that unfunded liability, and you're not going to earn 7% for 30 years. So again, the purpose of this is not to scream fire, except to scream fire. These numbers are not precise. But if you look at this report, you will see throughout the fractures that have been created by overpromising benefits and underfunding the pensions. And now here we are in an inflationary cycle, and the government is not bound to honor these obligations if it goes belly up and it's not sustainable. So as I'll discuss in our next video, we conservatives have been called union busters and called horrible things for the outrageous effort to call for years now, many of us, to fund these pensions. Whatever else you pay for benefits, that's a separate analysis. And now here we are in crisis. And it's time to have some fiscal accountability and integrity in our pension systems. And we need to move forward on that. And so many of us have some ideas about doing that, how to do this. Act 114 has taken some great steps, but now we need to fund it some more and not just assume we fixed the problem, because now, as we see, all the calculations and all the great predictions have just fallen once again down the toilet of reality. We have to deal with reality, and we owe it to those who have been promised benefits to be paid. And we owe it to taxpayers not to be saddled with a debt that they can't pay. That's where we have to come together. And that's what I'm going to be running my campaign on, as I'm trying to show here. I have some finance background. Again, speaking in some big loose terms, though, to try to connect the dots for Vermonters to understand why we're in such big trouble. If what I'm saying is true, then the shortfall of the pension is more like $9 billion now. And I would really love to hear from Treasurer Pierce about why that's not true. And we could have that discussion, because we need to fund the pensions. So my name is John Clark. I'm running for Senate for Orange County, and I approve of this message.